By 1944, the global economy was broken due to three major shocks. In 1929, the U.S. stock market crashed because investors had borrowed too much money to buy
August
stocks.
of 1929.
Prices were much higher than the company's real value. After the crash, people and businesses lost confidence and stopped spending. Companies made fewer sales, so they cut jobs. Many factories and businesses closed, leading to more job losses.
Desperately hoping for a job that rarely comes.
In the U.S., unemployment reached nearly 25%. In Germany, around 30%. The U.K. also saw major job losses, especially in industrial regions. After the crash, people and businesses lost confidence and stopped spending. Companies made fewer sales, so they cut jobs and closed. Why did all countries face the same problem? Because the U.S. economy was deeply connected to the global economy through trade and investment.
The United States and world markets plunged into general misery.
When American banks failed and people bought less, the U.S. stopped importing goods from other countries. This hurt their industries too. Also, U.S. loans and investments to other countries stopped. So many foreign banks and companies also collapsed. This global chain reaction caused unemployment to rise worldwide. Europe and parts of Asia were physically and economically devastated. Cities, factories, railroads, and banks destroyed. Massive war debt across nations. International trade nearly stopped. No shared system to stabilize exchange rates, fund rebuilding, settle international trade. Leaders realized without a new financial system, the world risked continued economic chaos, poverty, and even future wars. 44 allied nations, UK, France, India, met to design a new global financial system focused on stability and cooperation. The U.S. dollar would be fixed to gold at $35 per ounce.
Connolly to suspend temporarily the convertibility of the dollar into gold or other reserve.
International Monetary Fund monitor exchange rates, support struggling economies. World Bank monitor finance post-war rebuilding and long-term development. The U.S. held about 70% of the world's gold reserves. Its economy was strong and stable compared to war-torn regions. The world trusted the U.S. dollar, especially when backed by gold. Countries held U.S. dollars in their own central banks. They could convert dollars into gold from the U.S. Treasury at $35 per ounce. This limited U.S. money printing, since it needed enough gold to back the dollar. But cracks began to form in the system. In the 1960s, the U.S. printed more dollars. For reasons fund the Vietnam War and expand social welfare programs. Result for this inflation and U.S. prices began to rise. Other countries lost confidence and demanded gold in exchange for dollars. In 1971, France and others demanded gold for billions of U.S. dollars. The U.S. realized it didn't have enough gold to meet the demand. President Richard Nixon appeared on national TV and announced,
"I am suspending the convertibility of the dollar into gold."
Other countries could no longer exchange dollars for gold. The gold window was closed permanently. What happened next? Fiat money has value because the government says so, not because it's backed by gold. Exchange rates became floating, based on supply and demand, not fixed values. U.S. dollar remained dominant.